live webinar from Private Partnership. We serve clients living and working abroad and relocating overseas. What we are looking at today is the UK tax implications of expats with their UK budgets, with the UK budget. So how is it going to affect expats? Expats living in the UK and expats living around the world. And there's implications for both groups of people. And this is what we want to look at. In the current series of webinars running through to the end of this 2022, we're looking at residency status. What are the residency implications post-Brexit for in the EU and in the UK for expats that are living and working abroad? There's a big wide world out there, which we know, and the EU have never got involved in that. The EU has an extra layer of complication, and we're looking at how the changes need to be applied post-Brexit. We're considering in that series a domicile and non-domicile, EU citizenship against EU residency after citizenship, where a UK expat is like any other expat from around the world, as a non-EU third country citizen. We're looking at the introduction of electronic travel schemes and arrangements in 2023 by the EU, and how that's a revision and an upscale of the Schengen zone agreements. There's 27 members of the EU now. 26 countries are members of the Schengen zone. It's not exactly the EU members. 22 of the current members of the EU are in the Schengen zone, but of those, four of those that are not have applied to join, and 3 of those, Romania, Croatia and Bulgaria, close to being brought into the Schengen zone, whereas we're waiting a bit longer for Cyprus. Ireland have said and currently made no application to join the Schengen zone for a number of different reasons. But EEA countries, including Iceland, Switzerland, Liechtenstein and Norway, are part of the Schengen zone for visas for travel for non-EU citizens, non-EU citizens. So, and we're looking at this series about the difference between having a nominal EU citizenship right as opposed to how that's going to impact with Schengen visas for third country nationals. Thanks very much for that. I'm looking for a confirmation that my team are with me. They're not really here at the moment, but what to do? Right. In today's webinar, UK tax implications for expats after the UK budget. We've covered now the residency series and the implications, the broader implications of that. For the rest of this webinar, what we're going to look at is OECD, UK corporation tax, income tax changes, the impact of dividends on expats, capital gains tax changes, property and stamp duty changes, and then we'll wrap it all up for our clients. What's the OECD got to do with Brexit, and what's it got to do with the tax changes that the UK are introducing? The OECD and G20 introduced a set of new rules and requirements that are being introduced for expats around the world in the coming years. Now, the OECD pillars of change that need to be implemented around the world are gradually being brought in. In the budget, the UK Chancellor confirmed that they're going to do that, and have them enforced by the end of 2023. What that means is that UK-based companies will be subject to the OECD rules, which means that the minimum tax a company has to pay is 15%, and the uh, uh, if they feel that that tax is not being paid, it can either be charged as a local tax to make it up to 15%, or it could be charged as a reduction of allowances from invoices that may be coming from an offshore company. So this could have quite a dramatic impact for expats living and working abroad. If you're trading out of a residency, a location, or a company overseas where you pay no tax, the OECD rules will pull you in to assessment, and could mean that if you're operating from a UK personal service company, or if you've got overseas interests and employees, then there could be some additional corporation tax. So that, in essence, the objective is that in a digitalized economy moving around the world, that all companies have got the freedom of movement to go expat, but there's a minimum level of tax going to be paid at 15%, whether you're based in the Middle East, or whether you're based in the UK or Europe. Now, some countries will still pay more tax, some will pay less. And that is the road that's been rolled out in the coming years. And the UK have confirmed that they're accepting that from next year. However, these OECD pillars only apply to companies with turnover greater than 750 million. So that's a lot of money. Okay, so it's not going to affect a personal service company. It's not going to affect a small business. It's only going to affect the really, really big companies. And good luck with that, Google and Facebook. But the principle is, the mechanism is going to be in the system. The exchange of information has been going on. Once a compliant zero sourced expat location for business, it has got that reporting and that exchange of information in place for big companies. It'll also be there for smaller companies. An exchange of information will bring closer scrutiny in years ahead. So the tax liability is not there. The exchange of information liability is coming in for UK based businesses from the end of next year. Also within the budget, there is some talk, there's some provisions to improve the scrutiny of transfer pricing. So again, if you've got corporations around the world and you're transferring invoices between the two, it then again allows for a disallowance of that transfer pricing to invoice out profits from one country into another jurisdiction. So it can be a real issue for expats living and working abroad. And so the OECD rules are quite wide-ranging for very large businesses with large turnovers, but the learning that will go on will have a greater impact for personal service companies and expats operating companies in a number of different jurisdictions. The next part for me to look at is to look at UK corporation tax. And what I want to do here is examine in more detail what the changes mean. So the headline figure is that UK corporation tax has been increased from 19 to 25%. Now, this is a provision that's been in place since the previous April's budget, and it's already in legislation, but then it was proposed to be withdrawn, and now it's been confirmed that it's going ahead. So from the 1st of April 2023, UK companies will pay a corporation tax rate at 25%. However, it's not as bad as that. If your net profit is below £50,000, then you'll continue to pay 19%. And then there's tapered relief, so that only companies with a net profit over £250,000 will pay the full rate of 25%. So again, the very small businesses, the personal service companies, the contractors, there's effectively no tax rate change there. The people under risk, the expats under risk, are those using a UK service company, and they're doing cross-border invoicing with a second company. So we've got transfer pricing from a low tax jurisdiction to take revenue or profit out of the UK company. Those tied to transfer pricing rules or the new OECD pillars could have an impact on what you're doing to enable a tax office to disallow allowances on that transfer pricing. So, in summary, a UK company is a low-cost option to run, and Proact, we help expats establish UK companies and administer them to operate abroad, living and working abroad. The very low cost, the tax is still relatively small. It's not zero, but it's a flat rate tax. So if you're in a high tax location with potential liabilities to higher rates of tax, then it limits the amount of tax you're going to pay to 19% up to 50,000, and then it rises beyond that. The rise up to 25% it takes place in stages up to net profit in excess of £250,000. For more information and guidance on how you may need to refocus and readjust your expat business, contact us at proactpartnership.com. The next big change is into income tax. Now, the income tax changes are not much changed today. There were some tax increases announced a year ago, and then some of them were going to be reduced. And in effect, the interim budget has been removed. So the tax increases were going to be applied have been confirmed. But the progressive nature of the taxation is that allowances and thresholds have been frozen for a period up to 2028. So there'll be no changes in the personal allowances in the UK during that time. So if you're an expat living and working abroad in the UK, then you've got, I do use round figures, as people who watch our show and subscribe to our YouTube channel know, they've got about £12,500 in the UK they can earn tax-free each year before they start paying income tax. But that threshold is being frozen, as is the threshold for 40% tax and a 45% tax. Now, the additional rate of tax originally applied over 150,000, but that additional rate of tax of 45% is now reduced down. That's going to apply from 125. Now, this is a big simplification for the UK. So if you earn more than £125,000 in the UK, you'll pay 45% tax on that additional income, or so you think. It's not quite as clear as that, because the Scottish Parliament have got a separate income tax system, and there's a separate additional tax rate on there. So the additional tax rate on income doesn't apply to Scottish residents, even though they're UK tax residents. It only applies to people England, Wales, and Northern Ireland. For more information guidance on that, contact us at proactpartnership.com. The significant factor, though, to remember as well, this in the simplification, is that if your income is above £125,000, you don't get a personal allowance as well. So you're now going to jump from 40 to 45 straight away and lose your personal allowance. So the marginal tax increase is quite strong once you get into a six-figure salary in the UK. Now, you can reduce that using a personal service company. Say up to a 50,000 salary, your flat rate of tax is still 19%. even at 250,000, your corporation tax rate is still only going to be 25%. So there's still, if you can work on a contract basis as an expat in the UK, a potential to earn that extra money. Non-DOMs in the UK already could use non-DOM rules. An expat living and working in the UK that's not from the UK is treated as non-DOM, and that their worldwide earnings doesn't have to suffer from UK tax. So there's an opportunity there to reduce the total amount of tax by organising your affairs to earn your money overseas and not remit it into the income if you're not domiciled. So you may, for example, have an offshore company, and if your turnovers are right, you can still take advantage of that to make sure that your earnings are outside the UK and only your UK income is taxed. Whether that's property rental earnings or gains within the UK. So for more information, guidance on non-DOM strategies for UK-based expats, contact us at proactpartnership.com. So if the main brunt, as I see it, on a personal level, for the budget, is that those people that have lived and worked as employees in the UK and received subsidies and handouts during the COVID period are now going to have to pay back that additional debt. But that does directly relate to employees and the self-employed and the earnings from those. So for expats, the non-DOM rules essentially weren't touched. And if you are living and working abroad outside the UK, then obviously UK rules don't affect you. So for more information and guidance on how the income tax rules will impact you and what your tax return is going to be, especially if you've got non-DOM status or non-residence, contact us at proactpartnership.com. The next area I want to look at today in our UK review of the UK budget and the implications for expats is dividends. There's no increase in the dividend taxes per se. They have gone up recently, but the allowances have been changed. So there's an additional personal allowance for dividend income, and that is to be reduced in the coming years. So from an additional 2,000 allowance for dividend income today, that's being reduced to 1,000 for the next tax year, then 500. So it's quite a significant reduction of 75% in the additional personal allowance before you start paying the dividend tax. So the dividend tax is not going up, but the allowances for dividends before you tax it is going quite down. So it's a big disincentive for anybody that is working from their own small company as a small, medium-sized business or personal service company. A dividend strategy is losing, potentially going to pay up to an additional 33% on an extra, which would mean an extra £500 tax just from that reduction in dividends over the next two years through to April 24. So for more information, guys, you can maybe change that. Do you use an expat strategy, an offshore company to protect some of your overseas earnings? Contact us at Proact Partnership for a free review and guidance. Similarly, capital gains has been attacked. So let's have a look now at capital gains and how capital gains is being impacted. Capital gains has changed quite rapidly in that the allowances are going to be reduced dramatically, again by 75% over the next 2 tax years. But it is literally, it's not 2 tax years, it's over 18 months. So from April 23, the current capital gains annual allowance of 12,300 will fall to 6,000, 50%, and then from April 24 in 18 months' time, 15 months' time, falls to another 50% to 3,000 a year. So as capital gains goes on your highest marginal rate of tax, that additional £9,000 of capital gains allowance that's lost could mean as much as £4,500 additional tax just by doing nothing. So from those capital gains. So if you're holding investments or business shares in the UK, you need to make sure that you use your allowances to maximise your gains and minimise your future liability from that. If you're a UK expat living and working abroad, you can hold your assets outside the scope of UK capital gains tax assessment. Do consider that it is quite an issue that nothing was changed, but if you're a UK domiciled expat living and working abroad, if you get a capital gain arising in the UK, it is reportable, but there's no tax applied up to 5 years. So if you remain non-resident for those 5 years, that capital gains tax liability falls away in the UK. Now they haven't attacked that. So that means that if you're an expat, whether you're a UK expat or a third, somebody from outside the UK in the EU or around the world, investing in the UK in business or in investments, you can still potentially get a capital gains tax relief on that, but your assets do become at risk. You can hold assets in a different location and change the tax liabilities using a family trust, using a family company or an offshore company as a way of reducing the potential liability. Now, 10, 15 years ago, you might have been able to expect to pay zero tax on your capital gains or your investments worldwide. And that's not necessarily the case anymore. The OECD pillars are looking for larger companies to pay a minimum 15% tax. You can still enjoy a zero tax when you're working remotely or you're working cross-border, but the exchange of information and the learning process is changing. So protect your capital, protect your assets in the long term for your family and business. Contact us at proactpartnership.com. And there's more on this in our other episodes in this series. You can watch them at our YouTube channel, so subscribe and stay in touch with that. The next area I want to look at is changes. A lot of expats, whether UK expats abroad or expats investing into the UK, buy property. Residential property in the UK is a fixed capital gain, and it's a fixed income. Property rental income is a fixed income in the UK, so they both fall within UK tax scope. So if you've got a very large property portfolio and you're earning over £125,000, you straight away you're into 45% tax. Now there is no way to mitigate that. If your investment asset is in the UK, then that income is arising in there. So for somebody who's got a property portfolio in the UK, there's potentially significant changes for that. If you've got a smaller property portfolio and your rental income is below 12,500 each for, say, a married couple, then yes, you can still enjoy the personal allowance if you've got no other UK income. So investing in UK property can be a tax efficient income investment income source, but for larger portfolios, it's worth planning ahead. And don't forget that capital gains tax reliefs are being phased out. So if you've got a large portfolio and you're sitting on a capital gains liability, that liability, even if the price doesn't change, is going to go up because your allowances are going to, the capital gains allowances are going to fall quite dramatically in the next 18 months, which can make quite a difference. So at the moment, a couple owning a property that sell that UK investment property, a residential investment property, can get, and they've got no other UK income, could use their £25,000 personal allowance against any capital gains liability. But from 2024, that sale will only attract a maximum allowance of £6,000. So that's an extra, nearly an extra £20,000 of tax liability on capital gains, which could be taxed up to 45% if the gain in the year is over £125,000. Again, the UK have changed temporarily through to April 23 the personal allowances for allowance for stamp duty. So new people buying property in the UK have got an exemption up to 250,000 of stamp duty. Sorry, repeat buyers have got buying a second investment property in the UK can get an exemption up to £250,000 of stamp duty as an individual. First-time buyers can get an exemption of up to 425,000 of stamp duty, but that again only runs to March 25, when it might be renewed or it might be withdrawn. So investing in the UK property is being encouraged by the UK authorities. Now that could mean that it's a good time to sell. It could also mean you could make good capital gains in the next few years. But offset against that incentive for new people to enter the property market is the reduction in the allowances for the people that get the gains. So that the investors holding property and benefiting from property gains in the next few years will be paying for the incentive for new people to pile into the market and put those prices up. Doesn't mean that property is a bad investment for an expat. UK property has been a good investment for very many years. So contemplate that and see how best to organise your portfolio of property. Stamp duty applies whenever you transfer your property, whether you if you transfer it into a family trust or into a company, you'll still have the stamp duty to be applied. So you can't avoid it per se. So the time to plan ahead as an expat when you're buying and selling UK residential property is when you make that purchase arrangement. So for expatriate advice, contact us at proactpartnership.com. It's the sort of advice we can give you online with your advisors in the UK about how to plan to protect your family against that future capital gains liability. The other tax I didn't mention in my initial introduction is, let's have a look at inheritance tax. Inheritance tax, effectively, there's no change. But what that means is that the allowances are fixed. So with the average property prices in the UK are almost now the same as a personal allowance. And there's big reliefs for a family, but the allowances are being fixed and frozen again in the coming years for the next 5-year period. What that means is a creeping 40% inheritance tax liability that can be applied to estates. It's the fastest rising tax in the UK, and every day we're getting more and more expats that are finding themselves emerged in UK inheritance tax complications when family or parents, grandparents, partners die, and they're left holding as an individual assets in the UK, which are then subject to inheritance tax assessment. Even a premium bond holding could enforce an inheritance tax assessment, which would then potentially have a scope of your worldwide earnings. But even if it's in the UK, if you've got a significant property liability, that inheritance tax liability is still with you and follows you even after you've left the UK, because inheritance tax is charged on domicile status. So again, look at our residency series on our YouTube channel, subscribe and look at a bit more. Inheritance tax is charged on domicile. So technically, when you die, exchange of information or freeing up assets means a tax clearance in the UK will lead to an assessment for that inheritance tax liability around the world. So let me go to my summary now of our webinar today. Thanks for listening. We did a summary of our residency series and the reasons for that to prelude the today's webinar, where the topic was UK tax implications for expats of the UK budget in the autumn of 2022. We've looked at that they've confirmed the changes of the OECD rules, and although that impacts big business from 2023, it means that there's going to be a capacity inbuilt into the tax system to exchange information and make sure that minimum tax is charged either by an additional tax charge in the UK or not allowing allowances to be applied, and hence increasing net profits. We looked at UK corporation tax. Headline figure is that corporation tax for a UK company is going up from 19 to 25% from the 1st of April 23. However, net profits below 50,000 stay at 19%. So there's still an opportunity to use the UK as a personal service company and still retain a flat rate of 19% tax on the overall income as an expat living and working abroad. Even so, a flat rate of 25% may still be preferable to the 45% tax rate for higher rate taxpayers, additional rate taxpayers in the UK. We looked at the changes to income tax. The big change is the simplification, which means that at 125,000, you're onto 45% tax. You're losing your personal allowance and you're jumping from 40 to 45% tax on your income, dividends and savings in the whole of the UK. Having in mind, if you're a Scottish tax resident, the additional tax rate doesn't apply. There's a separate Scottish tax that applies to that. So many expats are going to be brought into the net for that, and the marginal rate of tax with the loss of the personal allowance, the jump to 45% could mean a big jump in tax. So if you've got business or property or investments based in the UK as an expat, contact us at projektpartnership.com to review how we can help and guide you, organise your capital, family and business for more tax savings. We then looked at dividend income to say that there's an additional personal allowance for dividend income, and that's going to be slashed by 75% in the next two budget periods. So we're talking about a period between the end of 22 to April 24. The allowances, the additional allowance for dividend tax is going to be reduced by 75%, which could mean an additional tax by doing nothing, using a dividend strategy for paying your salary, could mean as much as £400 or £500 of extra tax if you take no action. We looked at capital gains. Again, the allowances are being cut in half and then half again, 75% reduction in the allowance of capital gains. So if you're a crypto investor or you're selling a business or shares or commercial property, your capital gains liability is going to go up even if you do nothing. So the capital gains allowance is being reduced by £9,000, which again is about £4,000 to £5,000 worth of additional capital gains tax if you take no action to protect your capital, family and business from the UK changes as an expat. With property, things are largely unchanged except that stamp duty allowances have been inflated for first-time buyers and for new buyers. So there's no stamp duties applied on a temporary basis up to 2025 on £250,000 purchases. But that inflates the demand for properties below in the UK market, and should act as a catalyst to push up prices in the UK, and lead to more capital gains. So capital gains allowance is going down. The demand for property is being stoked up, and so it could be good property profits in the next year or two, but it'd be a tax bill that's payable in the UK. Plan ahead to protect your capital in your family and business property. Contact us at proactpartnership.com. The OECD changes are aimed at very large companies, but it doesn't mean that the new ways of holding that information and that exchange of information that will go on to allow transfer, tightening of transfer pricing rules, to make sure that companies pay an additional rate of tax, so that pay a minimum 15% tax, and also to make sure that allowances can be limited if it's felt that there's too much of a tax avoidance issue going on. So it's to increase the total amount of corporate tax that's going to be paid. So if you're operating a personal service company, working remotely, working as a nomad, there's changes to be made, whether you're UK expat living and working abroad, or you're an expat working in the UK. To review and reorganise your affairs, Proact offer you a free review. So contact us at our website at proactpartnership.com. Contact us, and you can either chat to us or organise a free review online, and we can help and guide you about how we can help you adapt your tax residency and your residency changes with Brexit and with the UK budget in the autumn of 2022. Thanks very much for listening, and we'll see you again next time, where we follow through with our residency series. Thank you.